Kind Profits here with another video. I tend to not report on uh, the latest news stories I see just because I want to be more general. And I think the news is more about just getting views than trying to be informative. But I did see a article on CNBC that I thought needed to be discussed because it discussed how it was an analyst from Vanguard who they were the people I talk about a lot as far as creating the first S&P 500 index fund. And what the analyst was saying is a big deal in that he was predicting that the sort of stock market return that we can expect in the future is going to be much less than what we're currently getting. And this is important because of the rule of 70. And that's the other concept I wanted to get into, which is when a stock goes up a certain percent, let's say it's going up 8% a year, or just for simple sake, let's say 7% a year, that means that if you put $100 in, after 10 years, you'll have $200 because it's that 7% increase a year. The way you get that, how fast it takes for it to double, is by taking whatever percentage it is and dividing by or dividing 70 by that percent. So if it was going up 3.5% a year, it would double in 20 years. But the stock market in recent years has returned a pretty great percentage. This is in the post-2008 financial crisis. We've had about 8% growth, and this Vanguard analyst was saying that in the future we'll only get 5% growth. And this is a big deal. It means that at 8%, if you invest your money, you should be doubling it every 8.5 years or so, which is pretty great. So in 17 years, if you put $10,000 away, that'll double twice. So first it'll double to 20,000, then it'll double to 40,000. So that makes saving for retirement a lot easier because your money's going up at such a fast rate. He was saying it's going to be more like 5% a year, and that this is going to affect how people are able to retire, and they might have to retire later and such. This is very bad news. People really need a high percentage return to be able to retire, especially because saving money is so difficult. It tends to be very hard to put a lot away. At 5% a year, that moves it up to it only doubling every 14 years. So 8.5 years to double versus 14 years to double. That's huge. It means that to double, it'll double twice in the same times where it would normally go up, or you will have 4 times. What would tend to happen is around the time you would get 4 times your money in the future, or let me word it a different way. In 24 years, 26 years, something like that period, you would have 8 times as much as you put in at the beginning. Now you only have 4 times as much. So that's a fairly drastic change. Hopefully this prediction turns out not to be true, or if it is true, some other factor will kick in. You might just have to invest differently, but it's definitely something everyone should be keeping in mind, is that we've come to expect these huge returns from the stock market. If it does go down to like 5%, it's much less of a great investment. So keep that in mind. Think about that rule of 70 again. That you just take whatever percentage you're getting and divide it by 70 divided by that number. So if you're only getting 1% a year, your money will double in 70 years, 2%, 35 years. It's a really great thing to keep in mind. It's easy math to do in your head. But if that's true, what this Vanguard analyst is saying, that the stock market is going to go down from 8% annual returns to 5%, that would be a drastic change to the way people are able to save. It also could be true that that's really just referring to U.S. funds, and that the period of time where the international markets really become attractive is about to come up, that we'll have to look overseas if you're living in the United States, perhaps to emerging markets, to get those higher returns that we've come to expect. Anyway, it's just something to keep in mind. I'm going to put the article in the in the description of the video. Kind Profits out.